the housing market is going to crash? Well, probably not. But since I have your attention, I want to use this time to talk about our housing market. What the hell is going on with it? Prices are going up, demand is going up, supply is going down, everybody's panicking, buyers are panicking, now sellers are panicking, everyone's panicking. And there are a lot of really bad takes out there. And again, you can have an opinion about it. Some of them are just two extreme sides of the argument. One is the folks who say, well, this is 2008 again. It has 2008 written all over it. It's going to happen. A crash is going to happen. We're all going to die. It's going to be nasty. And then on the other extreme side of it, you have folks who potentially their interest is tied with the market being so good. Realtors, mortgage brokers, and so on come to us and say, no, this is a normal market. Everything's fine. Prices are going to keep going up. Keep buying houses. While subsequently going to the sellers and saying, sell your listing because market's going to go down. So obviously it's hard to trust that kind of take, but I thought that today we can discuss the housing market, the real estate market, what's happening with it, what are the supply and demand factors that are affecting it, and maybe we can have just a conversation about where the market is going and potentially how you can prepare for it. It's mostly from an investor perspective, but also if you're a home buyer, this video can help you as well navigate the market. This is from someone who doesn't have any vested interest in either or. Obviously, as investors, we like the market to go down. This is market the way it is. There's not much upside to it. We love the market to go down for us to buy all those nice rental properties, all those nice commercial properties at a bargain. But the truth is that we want to discuss the market mostly and what are the factors mostly affecting it, overall prices, and just my opinion of it based on the data that we have. But before we get into all that cool stuff and exciting stuff about the housing market, we want to do some boring stuff first, which is explaining some basics about supply and demand, elasticity, and how it's affecting price. Again, we're not going to go really deep into that. We're not going to make you an economist overnight. All it is fourth grade economics, basic supply and demand. And if you know it already, it's a good review. You can just skip it. But if you don't know it, it's a good time to just understand how does it work, how does the pricing work in the market, and what do these people mean when they say supply and demand. Because every time I hear a realtor talk about real estate market, they say, well, supply and demand, and they make the conclusion that they would make anyway. So what is supply and demand? In a free market, or supposed a market that is claiming to be a free market, a price of a commodity, product, or service is a function of two things. Number one, its internal characteristics. Number two, market factor. What is internal characteristics? Internal characteristics are things like its design, its innovation, its value proposition, its use case. How can it help a customer? So if you have a product that has a higher value proposition, a much better use case, most people can use it, it's very unique, it's very innovative, obviously the price of it is going to be higher because of the characteristics that it has within it. For example, just like an iPhone is a very cool design, very innovative, it's always improving on the previous version, or they tell us, we don't know. And because of that, it has a price tag that is higher, that kind of makes it itself to a degree immune to market changes, but we'll talk about that more in a bit because that's a very tricky subject. And then number two is market characteristics. That's that cool supply and demand everyone's talking about. This is really nice. If you know about it, you're really cool. So we want to make you cool. So let's talk about supply and demand a little bit. So supply and demand are two market factors that are affecting the price of anything. It could be a product, it could be a service, it could be a commodity. Anything that you're selling, any asset class, just like real estate, is to a degree priced based on its supply and demand. So when it comes to the price, demand has a positive correlation with supply, meaning as quantity of demand goes up, price goes up. For example, you have this nice little wireless mouse that I'm a big fan of. Let's say that 100 people in this market need this mouse, and then the manufacturer produces 100 of these little tiny wireless mouses, which are pretty cool. But let's say that now this mouse is very popular. Some big TikToker just made a TikTok with it on one of those trending sounds. Now everybody wants this mouse. Assuming the supply is the same, if you have a potential product that had 100 people wanting it, now up to 200, 300 people wanting it, and the supply is the same, obviously the price is going to go up. And on the other side, you have supply, which is how many units of a certain product is being produced. This tiny little mouse is pretty popular. Let's say that 100 people want it, and there's 100 units being produced weekly. Suddenly the manufacturer wants to produce more because they want to do more marketing, and they start producing 200 units. Now you have 200 units, but the marketing didn't work. People don't like small mouses. People want gamer mouses with like 10 different buttons for their Fortnite. Suddenly you have 200 of these mice or mouses, whichever is the plural, in the market, and only 100 people want it. Well, price goes down because you have more supply than it's needed in the market. Again, this is a very basic simplification of it. We'll go into details more. But price of a product or service is always a function of its supply and demand, meaning there are different variations that can happen, different scenarios that can dictate pricing. But before we talk about these scenarios, there's something that you need to know is equilibrium, meaning you have a graph where you have supply and demand, and there is a part in that graph that supply and demand amounts meet, meaning let's say that for a product that has 100 people wanting it and you produce 100 of it, there is equilibrium, meaning the supply and demand is equal, what we call a perfect market, a perfect price, which reflects the true value of a product. And that means that price can be determined by other factors, mostly that internal characteristics that we discussed. But sometimes in different scenarios, things can change. Sometimes you have the demand going up, supply going down. What happens? Price goes up because you have too many people wanting something that's not as much available. Sometimes you have the other way, supply goes up, demand goes down. Ooh, prices go down because not many people want it. And then sometimes you have different variations of it, both can go up, both can go down. Sometimes it happens that demand goes up by a higher rate than supply goes up, prices still go up because even though both are going up, it's out of equilibrium, meaning demand went up faster than supply went up. Let's say that, for example, you have 100 of these and you have 100 people that want it, and suddenly month to month 200 more people want it per month, but then the rate that this is being produced more is 50. So production is lagging behind demand, therefore price is still going to go up. Obviously the price wouldn't go up as fast as it would if demand kept going up and supply would stay the same or supply would go down. I thought it would be a good idea to look at a supply and demand chart just to build credibility. Not really, but it wouldn't be a video if we didn't do some sort of spreadsheet, some sort of crazy graphs or something. But this is not crazy. This is very simple supply and demand. As I said, 4th grade economics. Very easy, nothing crazy, but it's good for illustration purposes. Is that, you know, you have demand shifters here, so demand usually moves on the supply line and vice versa. So you have demand shifters here, for example, and you see that quantity of demand and quantity of supply. So as demand moves up for a product, let's say that demand is really high, and this is the equilibrium I was talking about, is that the demand and supply are the same. Perfect market, right? The assumption is that the highest and best use case of a product or service should be reflected in its value, and this is where it does. Again, it's just a theory, but let's say that in this case something happens, something bad happens, the market's going through a shift. So you have demands going up, demand keeps increasing by a lot, and you have supply going down as well. And again, supply was low, it's lower than ever, so we have a serious shortage here. And that is a very unbalanced market, meaning you have a lot of demand factors that are affecting demand, pushing it up to the max, but you have supply factors that are pushing it to the minimum. So then you have a massive shortage here. So I just wanted to show you that what is supply and demand in illustration. If you know already, that's fine, but that's what happens when demand goes up and supply goes down. And that is that it causes a lot of price surges, and it could be unprecedented as well. I know, basic economics. Doesn't make you an economist, doesn't make you an expert, but it's just the basics to understand how the supply and demand work. One more thing before I go into the market, into the housing market. I know we're all anxious for it, but I wanted to discuss elasticity of supply, elasticity of demand, and just the general concept of elasticity for you. So elasticity in its simplest definition, and again, I want to give you the simple answers because there's no posturing and I don't want to make myself look good by using these weird jargons. So elasticity means in a causative relationship, when something causes the other, how much does the change in A causes the change in B? Meaning, how much does the change in one factor affect the other? So let's go through an example. Again, econgraphs.org. God bless you all. It's amazing. Check it out. They have interactive supply and demand. They have individual elasticity graphs or so on. It's pretty cool. But here we want to just look at elasticity of demand. So what does that mean? In terms of supply and demand, elasticity is basically means that two things, because at some point demand or supply can affect price, but at a threshold, price starts affecting supply and demand. And in this case, we want to discuss how price affects demand as well. For example, we have different commodities that are very elastic, meaning the change in price has a lot of effect on change in demand. So price is a big thing for them, for the consumers, and changing price changes consumer behaviors by a lot. And then on the other side of it, we have inelastic products, inelastic services, meaning change in price doesn't matter. The demand stays the same or more or less the same as price moves. And again, there's different degrees or variation to that. This is mostly a calculation of elasticity. So, for example, you have something like this, or something that's really close to it like this. This is a very, very inelastic product and service. An example is gas. It's very relevant. Gas prices are through the roof. Oh my God. If you go to any gas pump, everyone's depressed. I go there, I'm depressed. It's just a bloodbath. If you think about it, if you are not working from home, obviously, if you're going to work, if you have to commute, prices are going to make you disgruntled. They're going to make you angry, but you need gas. You need to go to work. Gas prices can change. Obviously, there are micro adjustments you have to make, but generally, when it comes to the market, the demand usually stays the same or is within one standard deviation, for example, because it's just that the value proposition of gas in our society is really high. But at the same time, you have something that's like this, very elastic, like lobster dinner, a lot of those luxury items, a lot of your vices, a lot of the things that you spend a ton of money on, but the value proposition or its necessity to your life is low. So as prices change, market demand changes a lot. So think of a product. Let's say think of that Fortnite mouse that we discussed. Again, if that Fortnite mouse is really good, there's a lot of demand for it. But if the price doubles, a lot of people are going to escape to our trusty little wireless mouse, and they say, okay, I cannot get enough Fortnite victories on that, but they can say, hey, it just does the work for me. I can still play Fortnite with this, so I'll just wait for the prices to go down, or I just don't need it. But overall in the market, suddenly there's a huge shift in demand based on price, changes demand, or vice versa. Same thing with supply as well. How much does change in price changes supply as well? Remember, this is a two-way street. There are a lot of things at play, so both of these factors affect the other. I know what you're thinking. Corey, you said you're going to talk about the real estate market. What is this economics lesson? We want to talk about market crash. You said the market's going to crash. Let's talk about the crash. Well, let's talk about the real estate market now. We're going to go through some of the supply and demand factors that are making the market the way it is. What are the elements of it, and what does that mean for the real estate market? So now that you know all the economic concepts on a surface level given, we want to talk about some of the supply and demand factors that are affecting the real estate, especially during pandemic and post-pandemic, that made the market the way it is. Again, huge disclaimer, this is just my opinion of how the market is going. Again, different analysts or different economists have different takes on it. Even though this might not be perfect, it's very methodical and it is without agenda. I'm not looking to sell you anything. So first of all, supply. We know that the supply is down. We hear about supply of housing, real estate overall is down. So let's analyze it a little bit. Number one is new construction and development. This is very tricky because in the past decade in the United States, some of those major developments have been lagging a bit, especially in the growing markets like here, Southwest Florida. There hasn't been much development in terms of multifamily or commercial. It's catching up, but it's been an issue. But with the pandemic and increase in demand, this has become more apparent. Also, construction has to catch up to keep up with the demand. Remember what we said? In order to stay with the equilibrium or something close to that in a balanced market, supply has to keep up with the demand's pace. Well, the bad news is it hasn't. The main reason for that is obviously we know price of everything has gone up. Price of material, which is lumber, masonry, especially masonry, things like, everybody's talking about wood, but also concrete, cement, sheetrock, shingles, even the appliance price has gone up. And again, the pricing is one issue. The other issue is the lead times. For example, with lumber and masonry, there is a high lead time. Personal experience, we're working on a construction project and the lead time for pre-cut lumber, which is 2x4s, 2x6s, is 8 months to even get on the list. Again, I don't know what happens when you get on the list. Probably you get on another list, wait for another 3 months, then you get on another list, and then they may ship you the product. Obviously, there's another part of it is that a lot of those manufacturers like lumber and masonry really love this market, and they want to give the impression that there is still in a scarcity so they can keep the prices the way it is. Again, not always, but this is something that we've seen before when it comes to some of the suppliers in Canada talking about, well, the price of lumber is up and going up, but in the meantime, the price are not up. It's been going through ups and downs, but I think there's a supply issue, but there's also suppliers really loving this market, and that very increased love for this market is a little too much for us. And then the second reason for supply is existing listings. As of today, with the rates going up, it's changing, but listings are very low. because what happened was that the demand went up. A lot of folks wanted to buy houses. Some of these low cost of living cities, the prices went up. Suddenly you have a lot of homeowners who have houses that they live in that if they were to buy today, they couldn't afford to live in. So why would I sell? If I have an opportunity to upgrade or to go buy a bigger house, well, this market is at height of its prices. So why would I list my property and go buy another one? And this one is the most recent with 2022 and feds wanting to increase rates as go by to battle inflation, to battle the housing market. Obviously, with higher rates, lenders who provide mortgages to residential sector increase their rates as well. You see the rates are hovering around 5%, 6%, going down, going up, which makes the cost of cash higher. So the cost of cash that you're borrowing, your leverage, every line that you have with debt, the cost of it just went up. So a lot of folks who might have investment aspirations or buying their second home or vacation homes, now, unlike 2020 and 2021, especially 2021, they're thinking again. They're thinking, well, should I really do this? Is that the right thing for me? Meaning taking advantage of home equity loans, home equity line of credits, HELOCs and hellos, and also listing their existing home to go upgrade or to move to another city. And it's usually from those attractive southern states, low cost of living states, to other states, because they're like, well, everybody's moving here, well, this must be nice, we're gonna stay here, and we can't upgrade because the prices are high. If we sell high, we have to go out there and buy high again. So unless you're downsizing, it's not worth it. And the last one is not so pretty. There are different opinions about it. Again, the data on that is shaky. No one can definitively tell you what part of the market it is applied to, but we have to talk about it. And that is private equity, hedge funds, and big asset management companies buying up single family homes. I know it's very sad, it's upsetting, but the way it works is that they think of real estate as a really good bet right now. Crypto market is down 1.7 billions in losses. Stock market is very shaky and dollar is losing its value. CPI index is closing double digits, which is kind of insane. So if you have a ton of cash, if you have a ton of assets, if you made a lot of money during COVID, especially if you made a lot of money during the tech boom and the big digital transformation with work from homes, a lot of companies digitizing, you have all that cash, and what do you do with it? You have to park it somewhere that, let's say, so you have to park it somewhere that's good, right? What's the characteristic of a good asset? It increases in value. They can't produce more of it. You might actually have an opportunity to get cash flow out of it. Real estate? Well, yeah, they invest in real estate. But here's the ugly truth. When it comes to single family homes and communities or built to own communities, which means when an asset management firm or a private equity firm goes to a builder and says, build me this community, 80 single family homes, and I'm gonna buy all of it. Or they go to a specific market, especially in these southern states that are very attractive, and start buying out a lot of specific single family homes. Down here in Florida, 3-bedroom, 2-bathroom, 1,600 plus square foot is their target. They get to purchase a percentage of the inventory in the market. The problem with that is gone for good. Based on what we've seen now, based on the behavior from these companies, they tend to purchase single family homes and keep it for a long time, if not forever. So unfortunately, the supply sometimes is gone. It's gone forever. And that's very sad. And that causes supply to go down more rapidly than we would like to. So we discussed supply factors and we left on a very depressing note, but let's talk about something more depressing, and that is ever-increasing demand. Let's start with the most obvious at first, and that is pattern of migration we've seen from high cost of living states to low cost of living states, specifically the states in the South. With COVID, a lot of companies were forced to work from home as we know it. Digital transformation happened, work from home opportunities happened, so you can make California salary but live in Fort Myers, Florida. Well, that's what happened. And a lot of folks who were homeowners in those high cost of living states sold their $1 million houses, sold their expensive houses, and came to this market and bought a house and got some cash on top of it too. They got to live in a very nice place with tropical weather. Again, the Florida weather is a matter of opinion, but a lot of people seem to like it, except when it's hurricane season. And we saw this pattern of migration as well. So southern states, especially Arizona, Texas, Florida, some of the rural states as well. But we saw that for these states, you have a very, very high net migration, meaning the inbound migration was outweighed the outbound migration, but maybe more than 60%. So on the high end of the spectrum, you have states like Florida, Texas, Arizona, and on the other end of it, you have states with a higher outbound migration like New York, California, and so on. So through this migration, those states that had a higher inbound migration, well, through this migration, now you have a boom in population in those states like Florida and Texas. Obviously, these states had a really high surge in population year after year as well. For example, Fort Myers, here in Southwest Florida, ranks number 5 in the nation with the net growth of 64.9% in 1 year, in the last year. And then the neighboring city, Cape Coral, right across the bridge, is ranked number 8 with a net growth of 58.6%. That is significant. And also, Cape Coral had a very significant year-to-year population growth. And if you have the pandemic and the net migration on 2020, 2021, and first half of 2022 on top of that, you have a city that wasn't ready for this kind of population growth. And obviously, there's limited supply, but if you have a boom in supply, the demand outpaces it by a lot. So the question comes in that, well, shouldn't the house prices only in Florida, Texas, Arizona, those kinds of states go up, and states like New York and California prices go down? Why is this trend national? Why is it bad everywhere? Why are the prices high everywhere? Well, for that, we go to number 2, increased demand for first-time home buyers. Let me give you a couple of data points for that. Freddie Mac said in the last year, it financed 554,000 loans for first-time home buyer, which is the highest level since 1994. And by 1994, I mean, that's the first year they started tracking this data. And not only that, the boom of 2021 was significant for first home buyers because it was 22% higher than 2020, which the 2020 numbers were 455,000 applications for first-time home buyers. So 2021 topped even that. And obviously, when we want to look at the market behavior, it says that millennial, Gen X, or a lot of folks who work in these sectors that allow work from home, allow work from out of state, they took full advantage of it. They said, well, if my company's in California and is giving me money according to California lifestyle expenses data, if I take that salary, go to Florida, I win. So home buying became a viable option for a lot of these folks who work in those jobs, who work in those sectors that allow work from home. And they said, well, it's possible for me. I make good money. I don't have to live in San Francisco. I don't have to live in Seattle. I don't have to live in Los Angeles. Why don't I come here, live in Cape Coral? But also there's an accelerator in this area, meaning that this was a trend for high income families. And again, there is a frustration, and I understand that. And that's due to this factor, meaning based on the same survey, 50% of the applications of those home loans that we discussed had a household income of 100,000 or more. So these were the families who made 6 figures or more, and a whopping 18% of all those applications were household incomes of 175,000 or more. So that's an accelerator as well, because people who buy houses, they're the ones who benefited a lot from work from home. They benefited a lot from those salary increases, maybe job hopping and increasing their salary, and also bought out the houses at a very high price. They could afford to pay the higher than listing price. They could afford to go to the battle in these bidding wars, and that left a lot of locals who didn't make enough money or didn't make 6 figures in the dust. So there's a lot of frustration there, and I understand that. We discussed this in the supply. Unfortunately, the effects of it are being seen in demand as well. And number 3 is hedge funds, private equity, asset management companies. The data on that is up for debate. There's a lot of analytics that are being made that people say, well, you just only have to calculate cash buyers into it. No, not every cash buyer is a private equity. Actually, asset management companies, you have a practice of taking loans out against existing assets to go invest in other properties, cash only. Or sometimes they use working capital loans, business loans, because they're large enterprises. They can get a ton of loan at a lower rate with a more flexible repayment to go and buy up these properties. So it's not that necessarily they go buy properties using cash only. Again, for that, we have to go to Redfin. Redfin says 1 in 7 homes in the United States in the past year in the metropolitan areas, big cities, were purchased by an investor. Again, this doesn't have to be hedge fund or private equity. It could be institutional investors or individual investors like you and me as well. But this is also concerning because it's been the highest in the past 2 decades. For example, in Tampa, 18% of the properties were purchased by investors. In Jacksonville, a whopping 22% of the single family homes were bought out by investors as well, which means that in that specific market, 22% of the supply was being bought out by investors. These are places that are designed for living and they bought out by investors. Obviously, some of them can be repurposed for rentals as we know it, but if it's big hedge fund, big private equity, they might have plans to just hold it as an asset, not rent it out. So you'll have just a situation which is very weird in some of these cities. A lot of empty homes are there, and just because the owners are using them as just an asset or they might not be interested in the cash flow of it, they don't even rent it out. So not only you don't have any options to buy a property, sometimes it's just so awkward that you can't even rent these properties out and they stay empty, or they're being used for Airbnb, private vacation rentals, things like that, short-term rentals. STRs are a big deal these days, and that's out of the market. Obviously, with investing, we know that the cat is out of the bag thanks to social media, TikTok. Everyone's a real estate guru these days, so there's a lot of content, there's a lot of push for people to go invest in real estate, and some of the barriers are being moved. Again, right or wrong, this is happening. A lot more folks, whether they're institutional investors or individual investors, want to invest in real estate. And when it comes to some of those other types, which is Airbnbs or short-term rentals, now you have a significant portion of the market going to those houses. So these are primary places of living that are being repurposed for short-term rentals, and obviously it hurts the supply a lot, but it also means that there's ever increased demand there as well. So now the conclusion: this is not a normal market, this is not a balanced market, and I really resent that a lot of real estate agents and brokers and mortgage brokers tell all of us that, oh, this is the normal market and that prices are gonna keep going up, there's no stopping to that. That's not true. Maybe that's true a little bit, meaning that in a lot of markets the dynamics have changed and there is a new normal. Unfortunately, we just don't know what that is yet, because there are a lot of temporary supply and demand factors that are yet to be remedied. But when the dust settles, then we'll get to see the new normal. Again, that's just a personal opinion, but let's talk about some of those temporary ones. For example, price of supplies. Again, at some point the supplies have to catch up to the demand when it comes to new constructions. Lumber, masonry, things like that, appliances. Now with restrictions being lifted globally as well, you see the prices going back to the normal. That entices the builders and developers to be more comfortable with pouring the foundation. We saw that a lot of times builders for the past year or two in this market as well, they buy a lot of single family land and they sit on it until the price of supplies go down. The other factor we didn't discuss so much is the price of labor. Obviously, in a growing market, price of labor is high, but price of labor is something that is up across the board in every single industry. So that also contributes to this craziness that's going on. So as at least prices of supplies come down, builders will be more comfortable with building single family homes. So it'll increase supply by a bit. This craziness with the moving from state to state will hopefully come to an end. And again, I still believe that there are different tiers of buyers, and we only went through tier one, which are folks who make more than 100,000 and who are very wealthy, who have the ability to move from state to state and it won't matter to them, or retirees who have a significant amount of wealth and it doesn't matter where they live. But again, as houses become more affordable, now we see tier 2 and tier 3 buyers enter the game, which are regular folks who make maybe from $50,000 to $100,000, who are looking for a home but are more budget conscious. So they're looking for houses as well. So that demand surge may replace that. Again, this is something that we have to see. This is mostly consumer behavior, so there's not real answer on that. So more on that later. Let's see. Another one is that a lot of companies are revising their remote work to hybrid or on-site only. We just saw that with Tesla. Elon Musk mentioned that, oh, work from home is pretending to work from home. Get back to the office. You have to build these new cars. We have a great product, so back to the office you go. Or companies like Apple say, we love you, we care about our workers, but realistically, no, you got to get back to the office. Or they want to have a more hybrid model, or maybe it's something that a lot of companies really want to keep Silicon Valley, states like California or Washington alive. So companies like Amazon are providing incentives, and I think that could drive some more migration to those states and create a bit of a balance. But that is something that is just a hypothesis. We have to wait and see. And when the dust settles, I'm afraid that there will be a new normal. This normal means you still have your hedge funds, investors, private equity, a lot of those folks who not only increase demand significantly, but always keep the supply down. So that factor is not going away anytime soon. We have a couple of years ago, if you remember, New Zealand instituted a law that foreign investors who don't reside in New Zealand cannot buy property in New Zealand, which I thought was very interesting, but also seems like it didn't do any good. Seems like, yes, it did drive foreign investors out of the market, but since the New Zealand was instituting or looking at institute a very significant capital gains tax, that scared a lot of buyers. Also, there's a huge net migration to New Zealand as well. It's a great country to live in. I lived in there for a year, best time of my life. It's awesome. So I don't blame anyone for moving there, but that kept the house prices up, that kept the real estate market hot for years. Recently, as we saw, Canada instituted something similar, so we have to see how it goes. Again, Canada has a significant problem because it's a more contained market, and they see that, wow, the foreign investor involvement is really high, and a lot of properties are being bought out by these investors, and some of them are not even available for rent or anything. They're just empty units. It's always been in the US as well. We're claimed to be a free market, so obviously this is not something that will happen. It seems like for New Zealand, in that case, it didn't help as well. Some supply and demand factors still kept it up. That made the market pretty expensive and unaffordable, unfortunately. Let's vent a little bit. Don't pretend that this is normal. It's not. It's a very unbalanced market. It's not a good market, but it is a market. Again, the rules of the market are natural law. No regulation, no individual person, no individual contribution can change it. It is the law of our world. Even if you get rid of the free market, you still have market forces at play. They just have different effects. Again, I feel really bad because there are a lot of home buyers. You know, for a lot of us immigrant communities, it's the American dream. It's this like owning a piece of America. It's amazing. It's an honor. But unfortunately, if you feel like you're doing better, maybe your salary is increasing a little bit year after year, you're working hard, but the value of your money, the purchase price of your money, the value of your money, the purchase power of your money, hard-earned money, that's not the money that anyone else gave you. You earned it, hopefully. Seeing it year after year losing value at 8%, 9%, it hurts. And that the price of something that's very basic to you, which is a place of living, going up and you not affording it in the city you live, is crushing. I feel you. I understand you. And I'm crushed as well. But don't want to end on a depressing note. Hopefully things get better. Again, a cool off of the market, prices gradually going down is good, even by force with the increasing interest rates or a little bit of steering the market from our federal government. It can happen. Again, unfortunately, I don't think the prices pre-2020 will be back, which is very depressing. But with the markets making more sense now, maybe some of those bidding wars go away. You have more sensible sellers. You have less opportunistic agents, which are a lot of them in different markets. I love you all. I love all my real estate agents, but it's been tough looking at some of the listings out there. And that's it. I'm sorry, I told you the market's going to crash, but it seems like it's not crashing. But you never know. Some of the concerning factors that are affecting the market, again, are these leading to crash? I don't know. I don't know how much significance they have, but they're significant enough, at least statistically, at least when it comes to their utilization in the market, that is something you should be concerned about. Number one is alternative lending. I'm guilty of this too. I said, hey, one of the areas that you can get into real estate investing without much pushback, without much barrier, is private lending to help you with your down payment or portion of it or closing costs. Well, some of these are regulated, some of these are not regulated. Again, some of these are actually not even mortgage vehicles. I've seen individuals and businesses, especially businesses, use a variety of small business lending options to buy real estate. Those are not followed by any regulation that traditional mortgages are, or even Dodd-Frank. So I'm by no means suggesting they're a replication of those ninja loans or they're likely to default or they're issues, but what we see is that you have a ton of investors in the market that are very over leveraged, that the loan to value ratio of the properties they own is very high. So a lot of people can come to you, probably on TikTok most of the time, and say, oh, I made 10 million in asset in 2 years, or I made 20 million in asset in 1 year. Chances are they're lying, but in cases that are more realistic, they're highly leveraged. So that's just a risk. Again, is it causing a crash? Is it going to be an issue? No. But you have this underbelly of investors who are over leveraged, who sometimes really want to fast money, and the fear of missing out got them to invest in real estate with a ton of debt, and that's a potential risk. Another one are other services that help homeowners own homes. And we see that they're using alternative lending options for residential real estate as well, meaning they help with a portion of the closing costs, portion of the down payment, or they charge a fee to purchase the house all cash for them to win the bidding wars. Again, if a product is specifically designed for that unique market, chances are there's something going on. But again, most of the mortgages that we see out there, either it's the fixed rate or even the adjustable rate mortgages. You don't have those ninja loans that are adjustable after 1 year. These are usually 5, 7, 10 years. And again, you have to have an exit strategy with your property. You have to, unless otherwise you get hit with a new interest every month. And again, mortgage brokers love it. They tell you whatever you need to hear to choose those options, but there is a potential risk with it. It's not a ninja loan, obviously. It's not as bad as that. Every single mortgage that is being issued has to follow Dodd-Frank, and those regulations are, or at least leads you to believe that they're there to protect the consumers. Another issue is housing payments being too high for many families. A lot of families needed a house, had a fear of missing out, loved to live in these states. They came in and they bought a house that was above their means, so their mortgage as a percentage of their income is high, sometimes as high as 30%, 40%. Again, depends on what guidelines you follow. I personally would never want to follow gross income, but a lot of lenders still use that. So chances are when it comes to their take-home pay, it's 50% or higher. It can easily be 60% of your income going to mortgage alone, and that's something that underwriters are not looking at. They're not looking at your spending habits, they're looking at your income and debts that you have, but not necessarily some of the specific bills and things that you pay. So you know your take-home pay. Again, my advice is that just be careful, but that can also be an issue. Unfortunately, pointers or fear of recession, a lot of startups, tech companies like On Deck laid off 25% of its staff. Peloton, all those new tech companies going down or laying off a significant percentage of their workforce. Tesla is just going through layoffs as well. So wow. And that could cause an issue because a lot of folks are really don't have a lot of room to breathe because they bought these houses at the height of the market. And God forbid, I hope it never happens, but if something happens to them, they lose their job, they might lose that house too. So that may lead to some default as well. But these are just risk factors. Again, I'm not claiming that these will cause a crash. These are some of the things just to watch out for, just to look at, and just look at the data. I'll add some resources in the description. There's some more market data, market newsletters. Just keep updated on them if you're really interested in this. That's it. I know it's a very heavy topic. It's difficult. It took a bit of a time, and thank you for still watching. It means a lot if you stayed through the whole thing. This is a very in-depth analysis of the market. Obviously, a lot of people summarize it in 10 seconds. Market is going to crash because of this, or is not going to crash because of this, but I really think it's worth discussing it. Hope you didn't fall asleep. But as always, thank you so much. Thank you for watching. And if you're an aspiring investor or a business owner interested in finance or some of the more quantitative aspects of business, which I know, I work with small businesses. Most small business owners don't know about it. So learn about it. You don't have to listen to me, you don't have to watch my videos, but learn about them somehow. If you want to know more about equity and what does equity even mean in real estate and business, watch this video. It's really good. And also there's a really good ratio. It's called efficiency ratio. Very critical for your business. And if you're in real estate, we call it gross yield, or it's a replication of it. We discussed it in details. Watch it here. Other than that, have a great day and keep learning.